Bitcoin is behaving exactly as Bitcoin should perform. Don't look at M2, look at global liquidity. That's really been the root cause of poor performance from Bitcoin and other cryptocurrencies. Yields are trending upwards, and I would be pretty convinced it's going to test 6%. We're looking at a very distinct change in regime here, and the issue is how does the government really cope with it? So what Scott Bessent is doing, it's kicking the can down the road and funding that through printing money, although they're not going to call it printing money, they're just calling it funding at the short end of the month. The whole idea that the Fed leads the market is completely wrong. I just don't buy into this argument that the Great Debasement trade started last year. It didn't. My general thesis is that we are going to get a Great Debasement. What I'm saying is it hasn't really happened yet. And at some stage, that's the tipping point. And I think this is a global phenomenon. Now, if that's the case, that requires some rethink about the opportunities in Bitcoin and crypto. But I think these monetary inflation hedges are certainly worth revisiting. It may well be that the low point of the cycle is maybe around the turn of the year. 2027 may well be another great year.
That was Michael Howell, global liquidity expert and a man with a laser-like view into the inner workings of the global financial system. Throughout all of 2025, people were calling it the year of the debasement trade. Michael says the real debasement hasn't even started. He says what you are seeing in the price of gold is due to China, not the West, and that when the West finally does print, Bitcoin is the asset with the biggest multiplier on the planet. I'm your host, Rob Wallace. Welcome back to the Bitcoin News Channel. Let's get into it. Hello, Mr. Michael Howell. Thank you so much for joining us today.
Well, Rob, great pleasure to be here. Lots going on, as always, in markets. They never seem to stand still.
Yes, this is supposed to be the summer doldrums, but that is not what we are getting. Very active markets, never a dull moment. So let's get right into it. My first question I have for you is this classic chart that we were all watching last year in 2025, which was global M2 and Bitcoin. And we kept saying for months, oh, Bitcoin's going to catch up. Bitcoin's going to catch up. Well, somebody just resurfaced it over the last weekend. And the delta, the gap between global M2 and Bitcoin is wider than we've ever seen. Can you have some explanation as to what is going on here?
Yeah, I mean, it's very straightforward. I mean, what drives Bitcoin is not M2. M2 is a measure of, well, people call it money supply, but it's basically, it is the money, it's retail deposits in commercial or high street banks, okay? If you believe that is global liquidity or global money, then I'll come quietly, but it's not anymore. Most liquidity is wholesale liquidity. In other words, in the wholesale markets, it's things like repo or other off-balance sheet transactions. And that's really the thing to look at. Now, if you look at that particular measure, the correlation with Bitcoin's been remarkably close over the over this period. And maybe it's worth demonstrating that in terms of charts. But what I'm really saying is that this is really a definitional thing. M2 is not the metric to look at. It often gives very, very full signals. We don't use it in any of our work. And what M2 is really useful for is much more of a measure of what's going on in the real economy. So if you've got strong M2 growth, it's basically telling you that retail transactions are going at a good clip. And that's probably driving a strong nominal real economy. It doesn't tell you really anything or very much about financial assets, and particularly Bitcoin. Now, let me try and shift to a chart where hopefully I can demonstrate that. So the chart that I've put up is looking at the global liquidity cycle. And that is looking at the flow of money that is moving through world financial markets. It is not money that's moving through the real economies. And what I want to do is to draw a very clear distinction between money that's in the financial sectors and money that's in the real economy. Those two are very, very different pots of money. And as I often say, all money that's anywhere must be somewhere. But if it's in pot one, it's not in pot two. And you get the point. It can't be in two places at once. Therefore, if you're looking at declining global liquidity, which we're seeing now, that's really been the root cause of a poor performance from Bitcoin and other cryptocurrencies. And the reason that's occurring is not because the Federal Reserve is tightening aggressively right now, or for that matter, any central banks. It's much more because the real economies have got momentum and they're dragging liquidity out of financial systems. In other words, they're crowding them out. And that's really a problem. Now, I'm going to move on to the next chart, which basically illustrates the close correlation between crypto and global liquidity. Now, the chart that I put up is looking at nominal amounts of global liquidity, in other words, in dollar amounts. The previous chart was looking at a growth rate, an index growth rate. This is looking at changes. It's 6-week changes. The reason for looking at 6-week changes is purely to get rid of the noise. Even though this chart is still quite noisy, it would have been even more noisier without that 6-week change. So this is looking at 6-week changes in global liquidity, which is the black line. And then we've also looked at 6-week changes in a basket of crypto, which is called BES dollar, which is Bitcoin, Ethereum, Solana. And those are put together in weightings of 60% for Bitcoin, 30% for Ethereum, and 10% for Solana. And that, was trying to be a fairly anodyne basket of cryptocurrencies. So what you can see looking at the chart is there was a remarkably close correlation between these factors. Not least, it's impressive because global liquidity has been advanced by 3 months, i.e. 13 weeks. So it's a true predictor, and you can see how it's predicted, and actually also how it hasn't predicted in the past. But generally, the tracking has been remarkably close. So the key thing to watch, and to answer your question, which may be a long-winded answer, it's definitional. Don't look at M2, look at global liquidity.
And when you look at this crypto basket, of course, it has Bitcoin, ETH, and Solana in it. But as Bitcoiners, we say Bitcoin is the hardest money. It should react the most to this liquidity. If you take out the other two, ETH and Solana, does this graph change drastically?
Well, in truth, if you look at the correlations, you're absolutely right to say that Bitcoin is a dominant factor, and Bitcoin probably is the harder money. Solana is there purely for effect. I mean, it's just to make up the numbers in many ways. So I think we can discount that. Although independently, Ethereum, Solana, XRP, to name another one, Ripple's cryptocurrency, all have very close associations with movements in global liquidity. But probably of those, Bitcoin is the strongest. The only caveat I've drawn is that if you go back, I believe it was probably about 12 months ago, when there was a sudden surge of interest in Ethereum. Ethereum captured a lot of the liquidity in that period, and Bitcoin significantly underperformed Ethereum at that point. And that was one of the reasons that we thought it was probably appropriate to start to move towards this more balanced basket. But generally speaking, I mean, I agree with what you're saying. It seems that most of the movement or co-movement is coming from Bitcoin.
Yeah, it seems that when Bitcoin rallies, then there is an alt season after that. We did not have that over the last couple of years, but previously, of course, in the last cycle, 2021, 2022, we famously had the alt season following Bitcoin's run up. And so it just seems as if money goes further and further out the risk curve. And that's why you could see, I guess, Ethereum and Solana soaking up some of this liquidity.
Yeah, exactly.
And so when it comes to one famous line, you say, if money is anywhere, it's got to be somewhere. It's either in the real economy or the financial economy. And the way that you paint it is that these two things are pulling at each other, correct? Mm-hmm. Is that, and right now we're seeing the biggest capex boom we've seen in decades here over in America. And so a lot of the liquidity is being soaked into the real economy. Talk about the relationship between the real economy and financial economy. And instinctively, it feels like it should be better for everyone if the real economy is growing, but actually we've become so financialized that the financial economy and asset prices is what people really care about, it seems.
Yeah, I think it's a fair point, Rob. I mean, if you look at trends in markets right now, I mean, we would argue that there are two defining characteristics. One of those is this point that you've just raised about the differential between the real economy, which is, I think, on a roll. I mean, look at yesterday's New York Fed survey, the Empire State Survey. I mean, came out another sort of gangbuster number, and that is likely to be, underscored by the Philly Fed when they come out later this week. So I think what you're looking at is a lot of the business surveys are clearly showing the U.S. economy is on a roll. And, that's clear given the AI capex boom. And it's clear given the size of the federal deficit. The economy is getting goosed significantly. But that liquidity is coming out of financial markets. And I think the easiest way to see that is to go onto a chart that's a little bit later, which is this one, which is looking at nominal growth in the US economy. So NGDP growth and 10-year US Treasury yields. Now, one of the things that probably has focused most people's attention is that the bond market's not behaving terribly well right now. Yields are trending upwards. We've had the 30-year clearly break 5%, and it looks like it's going even higher. I mean, I would be pretty convinced it's going to test 6%. But effectively, what you're looking at is a very clear change in the trend in bond markets and the trend in yields. And what the chart that I've put up shows is the underlying growth rate of the US economy in nominal terms, going right back to the early 1950s. And you can see labeled on that chart, the black line is the nominal GDP growth. The gap between the orange line, which is the 10-year yield, and nominal GDP was very wide in the early 50s. And that was basically at a time when the Federal Reserve was actively doing yield curve control and pushing yields well below nominal GDP growth. And then in 1951, there was the Treasury-Fed Accord, where the Federal Reserve was allowed to plow an independent course and to set monetary policy by itself independently. And then you start to see a lot more co-movement between the bond market and NGDP, as you can see through that period. Now, where we are right now is probably at a similar point to that period in the early 1950s, just after the Treasury-Fed Accord, where it looks as if the ability maybe, or maybe the willingness of the Federal Reserve to control the bond market is being reduced. And it's quite likely that yields are going to start to move a lot higher. Now, to answer your question specifically, which is this good or bad for financial markets? The point is that strong growth is good for the E, but it's not very good for the PE. And it's not very good for bond yields, and it's not very good for risk assets, because risk assets tend to price off things like nominal bond yields, which is what we're looking at here. So if you're looking at rising yields, that's likely to be a bad configuration, essentially. And as you can see from the chart, I've extrapolated to say that it looks likely that US Treasury yields are going to move a lot higher and probably catch up with that trend in nominal GDP growth. And the key point about this chart is that if you look at where we are now on growth, on NGDP growth, we're at levels of somewhere between 6 and 8% at an annualized rate. And that's really the fastest rate of growth that we've seen in nominal GDP since the first half of the 1980s. I mean, you've got to go back a long way to see this. So, we're looking at a very distinct change in regime here, where people have got to be prepared for a change in the basis of asset pricing.
And we are confronted with the fact that we are about to cross the threshold of $40 trillion of national debt. And we've got the 30-year interest rate exceeding 5.3%. And we've been able to ignore this debt forever, essentially. At what point do you think it becomes untenable with these interest rates going up so fast, as well as the debt? When does it actually become something that the average person thinks about?
Well, I think the point is that if you start to come back to this whole problem of debt, which is generally speaking a global phenomenon, this is not just the US, and the US is not in the worst position. A lot of other countries, Europe, Japan are in far worse situations. Probably China's even digging itself a bigger hole. But it's not to say the US hasn't got a problem. Everyone's got a problem. And the question is, how do we get out of that? And the issue is that a big deficit, as the US is running a 6% deficit, that's clearly helping to goose the economy and boost GDP growth. The government will always be able to sell debt. There's no question about that. There's always an appetite for government debt. The problem is at what price? And with strong growth and a lot of potential supply, you're looking at yields, I think, well above 6%. And that clearly is a constraint in terms of funding. And you just got to think about, a lot of private equity, which has clearly been done at much, much lower interest rates, and that's got to be rolled. And, the problem comes that this is becoming a constraint, not just on real economic performance, because clearly high rates matter, not just to homeowners, but, if you're financing capex in a normal way, that tends to be a constraint. It's also a factor in terms of financial markets, because debt's got to be rolled over. And that becomes a lot more difficult at higher interest rates. So these are significant constraints we've got to start thinking about. And at some stage, and I don't know where that figure is now, people used to think it was around about 5.5 to 6%. That's the tipping point where the economy could start to move back towards a slower growth period. I'm not saying recession, but it would start to be a constraint. So we're getting pretty close to these thresholds. There's no question about that. And the issue is how does the government really cope with this? How do they keep all these plates spinning? How can they fund themselves and not derail the economy? And one of the things that Scott Bessent's doing, maybe quite cleverly, in fact, is he's tearing up the rule book, so to speak, and issuing a lot of debt at the very short end. So he's basically using the bill market to fund the government deficit. Now, at the moment, bills represent about 22% of outstanding treasuries. They've been a lot higher in the past. Back 15, 20 years ago, they were up at 30%. And it's not inconceivable that he could try and get the percentage back to those levels. Now, if that happened, that would be akin to monetization, in other words, printing money. All these things have a cost, but that would, I think, undoubtedly weaken the dollar. It would cause the gold price to go up significantly, and it would certainly underpin, I think, a big rally in cryptocurrencies. So I think we've got to be alert to, first of all, the problem and how the problem is being solved. And it's going to become more of a problem for the private sector than it is for the government, because as I said, the government can always fund itself.
And you bring up that it was a much higher percentage in terms of the T-bills back 15, 20 years ago. Was that a response to the great financial crisis? Is that how they dealt with the problem back then?
Yeah, in part that's true. I mean, there was a at that stage anyway, there was sort of a preference for allowing bill issuance to be higher. It was a lot higher in the 1970s, for example, but it basically was brought down because it was deemed to be a more prudent way of funding a government to have to try and issue longer term debt to actually extend the duration or the maturity of government debt. And some countries have done that successfully. The US did it. Britain actually is in a situation where it's done that historically very successfully. Other countries historically have not been very good at that, particularly higher inflation countries. But there's always been that bias. But you're right to say that it's been high in the past. So there's no reason why it can't be high in the future. And I think that's the path of least resistance that many governments are taking. So what Scott Bessent is doing is, by raising the bill issuance, is, as I said, it's coming at a cost. It's monetization. It's forcing the Federal Reserve, if you like, to keep liquidity at the front end of the market abundant so this funding can get through. But equally, it's being copied by many countries. So you're looking at, Britain is talking about reducing the average tenor of government debt. The Japanese are doing it. Germany's talking about it. France is certainly active in doing it. So this is not a single event. We're looking at governments generally, and I think that's the point that Bitcoin or crypto investors have got to start thinking about seriously. Is there seems to be a recognition that the path of least resistance here is not fiscal consolidation. It's kicking the can down the road and funding that through printing money, although they're not going to call it printing money. They're just calling it funding at the short end of the market.
Yeah, I think that's the long-term thesis of Bitcoin, why many of us got into it in the first place. And it's been sort of shrouded, I guess, for the last year or two with the AI trade and all that. But at the end of the day, they're going to have to print. They're going to monetize this debt. And whether it's front-loading the short end or what have you, they're going to find ways to do it. And so let's talk about those ways. I mean, we've got Scott Bessent and we've got Kevin Warsh, and it seems as if Warsh was put in there in order to work alongside Scott Bessent and deal with this debt problem and make sure that the economy is still humming nicely, despite the fact that we're dealing with these issues here. So what do you see in the relationship between Kevin Warsh and Scott Bessent, and what tricks and tools are they going to use to keep this party going?
Well, I think the first thing to say is it's a close relationship. There's no question about that. I think you're absolutely right that Kevin Warsh was put there so he could work closely with Scott Bessent. That seems to be the case. What are they doing at the moment? They're talking a good story. So Kevin is clearly saying that he's thinking about tightening monetary policy, but not actually doing it yet. my old boss Henry Kaufman always used to say at Salomon Brothers, if a central bank starts to talk like that, this is a central bank that doesn't want to raise interest rates, and I think that maybe is probably a pretty good takeaway. Generally speaking, what they've been doing is undertaking three things. They've been funding at the short end of the market, which is we've just been talking about. They've been trying to cap volatility in the bond market so they can keep the basis trade running and keep an orderly market. And that's really been the engine for that has really been Treasury buybacks. So the Treasury going into the market periodically, auctioning or at auctions, bidding for off the run treasuries. And that is basically not just taking duration out of the market, but really taking stale issues out of the market. And it's a little bit like saying, the analogy is, would you rather own a second-hand, car, or would you like a shiny new vehicle? And everyone prefers the shiny new vehicle. So basically, that's one way of actually keeping volatility and keeping yields low. So that's the second mechanism. And then the third mechanism is basically operating at the very short end of the market. There's a Fed operating at the short end of the market and maintaining liquidity. In other words, giving banks whatever liquidity they need. Now, there was an interesting statement a few days ago, which came out of the New York Fed, which said they were halting for a month the reserve management purchases, the RMP program, which has been brought in late last year, in December of last year, as a way of managing shortages in the repo markets. It was a liquidity boosting effect. It was actually a QE measure, although we were schooled very carefully by the Fed to say it wasn't really QE, but in fact it was. If it's yellow and quacks, it's a duck after all. So that's what it was. They seem to be taking that punch bowl away temporarily. And a lot of commentators have said, aha, this is Kevin Warsh starting to tighten monetary policy. I don't read it that way, actually. I think that all the indications are that he's going to keep liquidity running freely at the short end of the market. One of the things to bear in mind is that the Treasury General Account, which is the Treasurer's account at the Fed, tends to be run down quite aggressively at this time of year. August in particular sees the Treasury basically give out a lot of net cash into the markets and makes the markets normally very liquid. And it means that there's actually no need for doing the RMP, which is why I think they've suspended it. But I wouldn't read anything sinister in that.
How many apps does it take to run your life on Bitcoin? One to buy, one to send, one for Lightning, and another for loans. That's a lot of friction. Rhino replaces all of them. Stay to the end, and I'll tell you how Rhino can set you up with $21 in free Bitcoin. Rhino is a next-generation Bitcoin app built for actually living on Bitcoin, not just holding it. Buy Bitcoin with zero fees. Borrow against your stack without selling it. Move money globally on Bitcoin rails in minutes, rather than a wire that takes days. Buy Bitcoin with zero fees. Borrow against your stack without selling it. Move money globally on Bitcoin rails in minutes, rather than a wire that takes days. Set a DCA plan so your stack keeps growing, whether the market is up, down, or you're out touching grass. Bill pay, cards, and Bitcoin retirement accounts are all on the way. And your Bitcoin is never rehypothecated, never lent out, and never touched by anyone other than you. Biometric protection, 24/7 fraud monitoring, and you can move to full self-custody whenever you're ready. It's your Bitcoin always. Download Rhino for iOS or Android at the link below and use code BitcoinNews. Deposit your first $100 USD and Rhino drops you $21 in free Bitcoin straight into your wallet. At Rhino, you get the most Bitcoin for your dollar.
In fact, if you look at the next chart, this is the thing I think to start to judge in terms of what is going on with Fed policy. And this is looking at the 2-year yield, which is shown there in orange. This is the 2-year Treasury yield. And the black line is the SOFR rate. So this is the overnight rate in the repo markets. Now, typically what you find in rates markets is that the 2-year Treasury note is an extremely good predictor of what is going to happen a few weeks later, or arguably sometimes a few months later, in repo rates and consequently in Fed funds. So the whole idea that the Fed leads the market is completely wrong. The Fed tends to follow the market as regards rates. It's the long end that determines the short end, not vice versa. Now, it's possible for the Federal Reserve to, if you like, ignore that signal for a long time by pumping liquidity into the markets. And what you can see in this chart right now is that the orange line has broken upwards through the black line, indicating that the market is starting to discount some noticeable increases in rates in coming weeks. Now, that may or may not be the case, but it can be sustained. In other words, that disequilibrium or that imbalance can be sustained, providing the Federal Reserve is prepared to pump liquidity into the front end of the market. Now, what I want to show you is this next chart, which hopefully explains a little bit better what's going on. And what I've done is to look at the course of the SOFR less 2-year Treasury spread, okay, the orange line here, in this cycle, beginning in 2024, with latest data right up to date as of yesterday, and the black line, which is the same cycle from 2020 to 2023. Now, the reason for looking at that is that the SOFR less 2-year spread is a pretty good way of judging US monetary policy, the stance of monetary policy. Anything below that dotted line, in other words, if you're in that negative territory, is a monetary tightening. And you'll see what happened at the end of 2021 is there was a very sharp tightening, which caused that SOFR less 2-year spread to blow out to almost 300 basis points over negative spread. And that basically was maximum tightness by the Federal Reserve, which occurred around the first half of 2022. Now, through that period, Wall Street sold off, crypto sold off dramatically by 75%, I think Bitcoin was down. Wall Street was off 25%. Now, what I've put on the chart for reference, therefore, is that's the benchmark, that's the last tightening cycle, and the orange line is where we are now. And you can see that that curve the orange line began to follow the black line downwards, and now it's sort of started to veer upwards again. So it looks as if the market is beginning to adjust to the fact that it may well be the case that the Federal Reserve is deliberately slowing up on any rate hikes, and it's going to effectively square the circle by pumping liquidity into the system. Now, if that's the case, I think that requires some rethink about the opportunities in Bitcoin and crypto, and for that matter, gold, and we can come on to gold in a moment. But I think these monetary inflation hedges are certainly worth revisiting. I still think that the Fed was going to have to, hike rates at some stage, but I think this tells us where their biases really are. And the inclination here is to try and avoid rate hikes if they can, and basically to run the system hot, if you like, by funding very much at the short end.
And the funny thing is that Warsh was put in there to cut, right? That was Trump's mission for a year, find somebody that would cut rates for him. And where does he get this idea that cutting rates would be good for an economy that is running so hot, right? I mean, is it just because he's a real estate guy that's been in the game of real estate for decades that makes him think that the best thing in the world is always low interest rates?
Could be right. I mean, I think that makes a lot of sense. I think that, I would tend to take a slightly different view about why Warsh was put in. I don't think it was necessarily to cut rates. I think it may have been to hold rates where they are, or certainly to slow any necessary increase. So what you're seeing, or what you were seeing in the first half of this year very clearly, was a flattening of yield curves. And ever since the last FOMC, where I think Warsh, in my view, was clearer in what his intentions were, despite the markets and a lot of commentators say this was very muddled. I didn't see it that way. I thought he was clearer in terms of his intentions. And to my mind, that was the trigger point for a steepening of yield curves, really since that last FOMC. And that's exactly what you'd expect under this sort of policy outline that I've suggested. So if you're saying, well, okay, I'm going to let the markets tighten for me, so I'm going to allow the long end of the market to sell off if necessary to reflect stronger GDP growth, but I'm going to make sure that funding occurs at the short end by providing liquidity and printing lots of money. That's a recipe for a steepening yield curve. It's also a recipe for probably stronger crypto and a recipe for stronger gold. And I think we're getting those progressively. So, that's my reading of it.
And let's talk about the bazooka. The last time we saw debt to GDP levels this high, they had yield curve control back in the 1940s, correct? Is yield curve control on the menu? Is it something they could bring back in times of drastic measures?
Well, I mean, my view would be not. No, I don't think they can. I mean, the world has changed dramatically from the 1950s. The markets are hugely, hugely bigger. And the ability of the Federal Reserve, I mean, how powerful as the Federal Reserve is, I mean, it's small fry, a drop in the bucket relative to the markets. I mean, in crises, the Federal Reserve can act, but then we know from experience it's got to double, triple, or quadruple its balance sheet size to do that. And this is not on the agenda unless there's a crisis. So I don't think one can suggest that the Federal Reserve is going to necessarily, stand in the way or dominate things ahead of a crisis. I think my view is that what they're going to do is really square the circle by effectively printing money. And I think this is a global phenomenon. And one of the things, in fact, it's well worthwhile, I think, rereading the speech that Kevin Warsh gave to the American Enterprise Institute back in 2018, because I think he was very, very clear on his views there. And he's basically, in a nutshell, says, look, QE works, but you've got to think of it as a supporting tool, not a direct, sort of, if you like, first line policy. So I think my reading of this is that he's using this QE, although you might debate whether they call it QE, but effectively bill financing of the deficit. They're doing that. They're getting the private sector to do the QE in a sense, rather than the Fed, which is maybe a subtle difference. But what they're doing is just creating lots of liquidity, and everybody seems to be following the same model. Now, if you do that and you start to extrapolate, what does that really mean? Well, what it means is if the Japanese are inflating at the same rate as the US and the same rate as the Europeans, paper money cross rates don't change. They're going to be broadly similar. But the price of gold is going to go up and the price of crypto is going to go up. And that's the thing that I think we've got to start thinking about, because these are the two assets that, of course, policymakers always dish as being sort of irrelevant or, a barbarous relic or madness or whatever it may be. But actually, those are really the long-term benchmarks of value, because they both have got either directly fixed supply in the case of Bitcoin or more or less fixed supply in the case of gold.
And I've heard you say that, as Bitcoiners, we've been thinking about debasement for over a decade, right? We're thinking the value of our dollar is being inflated away. We need to protect ourselves. So we go into Bitcoin. And last year, 2025, was the year of the debasement trade. Will you say the debasement trade hasn't even gotten started? They haven't done the big print yet. Just wait until you see what they're about to do. Is that your thesis?
Yeah, exactly. And I think that, I just don't buy into this argument that the Great Debasement trade started last year. It didn't. And there's a chart that I've just put up, which is looking at the movement of gold in US dollars, okay, which, it was not a 2025 event. The gold price started to move very strongly in mid-2022. And what I've put on the same chart is a black line, which shows People's Bank of China liquidity injections. And this is, if you like, the QE policy of the Chinese central bank. Now, those two lines on the chart seem to correlate remarkably well. And there was actually a Substack I wrote up a few weeks ago, which said, actually, if you look at it in terms of percentage changes, the relationship is even more compelling than this. So you can see a very direct causation from what the People's Bank of China does and the price of gold. Now, let's explore that thought and sort of run through with it. My general thesis is that we are going to get a great debasement. So I'm not arguing against myself on that regard. What I'm saying is it hasn't really happened yet, because what we're talking about is effectively debasing money in the West, because future debts and future debts to GDP just grow exponentially. So they're going to have to dig themselves out of this hole somehow. But it's kind of in many ways a future hole, not a current hole. I mean, clearly, maybe it's a small hole that's getting bigger, and is a better way to look at it. But it's getting a lot bigger. China's hole's already enormous, because China's got this huge, huge debt burden. So China's already facing the challenge, and it has to dig itself out. And the only way history shows that you can do that is to devalue your debt. You can't default you can't default debt for the simple reason that your whole credit system is based on debt. Okay, so you've got to devalue it. In other words, you've got to get the domestic level of prices and wages up relative to your debts. And China's got a huge amount of them, as we know. And that's clearly burdening the economy. That burden, or that debt pile is burdening the economy right now. So what China is doing is trying to devalue the yuan internally. Now, I stress the word internally because they've got an external exchange rate and they've got an internal exchange rate. The external exchange rate and the internal exchange rate are separated by capital controls, by compliant state banks, and by huge foreign exchange reserves. So they can maintain a yuan or renminbi dollar cross through these mechanisms, but at the same time devaluing internally. And the only vent for that money is really into the gold market. Crypto is banned in China. They've doubled down on that. They've actually tried to stop very recently any exit of trust money into Hong Kong or other jurisdictions by tax penalties. And they've effectively doubled down as well on capital controls in general. So what they're trying to do, in my view, is to print money internally. And as they print money internally, the Chinese retail investor will buy gold. That's what's driving the price at the moment. It's not Western investors. It's the Shanghai Gold Exchange, which is really the marginal pricer. They've outshone. I mean, the volumes are not the same as COMEX or London. They're still behind. But in terms of activity and marginal pricing, they're much more important. And what you can see here is that the gyrations tend to go together. Now, my view is that what you're seeing, and I've just put up this chart of the yuan gold price, is that if you want to understand this monetary debasement that's starting in China or being led by China here, what we've got to think about seriously is what is the underlying trend in that debasement, because that's going to have a knock-on effect for gold globally. And in my view, gold is moving up with a trend line that I've indicated. And that trend line on the chart saw the gold price in yuan basically bottom exactly at the point it should have done, which was 27,000 yuan per ounce of gold. And what's happened since then is it's bounced through 30,000. So you've had that very clear test of trend, and it seems as if what you're getting is a stronger gold market. Now, China, it seems very difficult to see, obviously, exactly what China is doing. But from what we can tell, looking at the data daily, China continues to print money. And I think you've got to separate the dynamics of the gold price, which is being driven by the Chinese central bank and the need for debt or to devalue debt in China, from what's happening in crypto, which is much more dependent on the Federal Reserve and global liquidity, where I think there's more of a problem near term, simply because the world real economy is got a big appetite for liquidity, and maybe the Federal Reserve is not printing it fast enough, but let's see on that one. But as I said, it looks as if what Kevin Warsh is doing is trying to give the markets what necessary liquidity, what liquidity they think is necessary.
And just over the weekend, you put out a piece, because first you look at, of course, Chinese liquidity matters more for gold, but then you say Fed liquidity matters more for Bitcoin. But then this piece this weekend is about untrusted money versus total global liquidity mattering more for Bitcoin. So explain that, and what was the outcome of your paper?
Yeah, that was an interesting exercise. That was basically this is one of the charts that we put up, which is looking at the overall movement of crypto and global liquidity. And one of our readers said, does it make any difference if those countries that are big Bitcoin users expand their liquidity faster or not? And I thought that actually that's an interesting thought, because it's one that's worth exploring with data. So basically what we did is we gathered as much data as we could, showing Bitcoin usage by country. In other words, what percentage of the population were using Bitcoin country by country, where, this data is maybe questionable in many cases, but it gives a broad indication of Bitcoin penetration. And we use the inference to say that if there's a big Bitcoin take up, is it that residents in that country, investors in that country, distrust the local money? And that would be probably a fairly plausible inference to make, So what we did is we correlated Bitcoin usage with liquidity by country and created a new aggregate, which was, if you like, a global index of trusted and untrusted money. So in other words, where you've got high Bitcoin penetration, that gives you the untrusted liquidity aggregate. And then if you've got the difference, if you like, with global liquidities and the trusted bit, and we looked at which was the most important driver of Bitcoin. Now, the interesting, I mean, the conclusion was, interesting, but maybe I'm not going to say a non-event, but it didn't really necessarily show what you'd expect. Put it that way. What it showed was that, or maybe to step back, what we argued right in the front was to say that you've got two drivers of Bitcoin or cryptocurrencies. One is, if you like, the intensive margin. It's, in other words, individuals saying, well, I want more or less Bitcoin for this stage of the cycle or because I fear inflation right now. So they've got a portfolio and they're changing their allocation. And then you've got the other, which is what you would call the extensive margin, which is basically people saying, well, okay, maybe Bitcoin is a good idea after all. I've never had it before and I'm going to start using it. And so you've got the penetration effect of new users, which is a little bit like saying, the S-shaped growth curve of mobile phone users, or the S-shaped growth curve of the internet, or whatever it may be, or washing machines or telephones or whatever. And basically every technology goes through an S-shaped growth curve where the take-up's very slow at the beginning and then it starts to grow exponentially and then it tails off. And so you've got these two effects. And the conclusions we came to is that the strongest and most consistent impact on Bitcoin and crypto, in fact, it was specifically Bitcoin, I should say, on Bitcoin, was the trusted money bit. So if trusted money moves, you tend to get a very strong and consistent correlation with Bitcoin. But it didn't have such a strong multiplier as the untrusted money. And what it seemed to be is that the untrusted money has surges, unpredictable surges, and that tends to have a big effect on Bitcoin. But the consistent driver is, if you like, the trusted money bid, which we think is picking up that S-shaped growth curve, whereas the other is picking up the intensive margin. And that's a mouthful of thoughts, but that's pretty much what we were saying. Maybe it sounds a bit confusing, but broadly, bottom line was that just look at global liquidity. That's probably good enough.
That's probably good enough. So then let's look at Bitcoin in terms of global liquidity. You made it very clear that global liquidity in terms of rate of change bottomed back in 2022 and then peaked at late 25. And that's perfectly in line with the Bitcoin cycle. Now we see that rate of change slowing. When does it finally turn back around, and will Bitcoin be the first to sense it?
Very good point. I mean, I think the answer to the first question is that it looks as if you extrapolate the cycle that I've just shown you, the sine wave that you can see there, the dotted red line, is a 65-month cycle. And we established that about 20 years ago using Fourier analysis on the data. And that's been a robust indicator thereafter. And it would seem as if the cycle is likely to bottom sometime around about the middle of 2027. Now, that seems quite a long way away. I did a more recent exercise. So I said, well, if you just looked at what the Federal Reserve is doing and you basically try to frame Federal Reserve policy, can you get a slightly different answer? And the answer that came back was that if you were just looking at the Federal Reserve, it may well be that the low point of the cycle, the Fed cycle, is somewhere around about early 2027, maybe around the turn of the year. Now that may be pushing it a bit, but that's what the cycle data said. So the bottom line is it could come earlier, and maybe if Kevin Warsh and Scott Bessent are changing the rules here, maybe we ought to start thinking about that. But the markets never lie, so we've got to start thinking about getting into a position where we can understand Bitcoin movements and maybe put it in this context of changes in monetary conditions. And my view through this year has been, and I still hold to that I don't think 2026 is going to be a great year for investing in Bitcoin. but 2027 may well be another great year. And I think that's why we've got to start thinking about this, looking ahead. So that would be my take. So I think that's the key thing. And your second question, is Bitcoin going to be the most sensitive barometer? I think yes, because we've always said that if you look at the multiplier effects, whether you look at Bitcoin, Ethereum, you look at the S&P, you look at gold, look at tech stocks. Crypto is the most sensitive asset out there on the planet by far, and it's very, very sensitive to changes in liquidity. Therefore, yes, it will move first.
Yes, many of us have hoped that the bottom is already in because we've built such a solid base here around 60K. But if you look at the 4-year cycle in Bitcoin, we usually have one last flush at the end, which would line us up to about October. For that, this is a midterm cycle year. And of course, stocks have a hard time in September, October of those midterms election years as well. So we'll see what happens. But I guess my question for you is, when it comes to these cycles, what is it, right? Is it human psychology? Is it the cycles of the moon? Why is the global liquidity cycle on 6 years and line on top of that, the 4-year cycle in Bitcoin?
Well, I think the 4-year cycle in Bitcoin, I don't know. That was clearly at one stage a supply question, but I think that supply question is no longer relevant. So I'm not necessarily a believer in the 4-year cycle. In terms of the liquidity cycle, what you've got to think about is that, why are we debating what governments are doing in terms of monetary policy and whatever? A lot of it is about debt, and the average maturity of world debt is around about 65 months. And so this is a little bit like saying, drawing the comparison with, you go back to, I don't know, maybe the industrial business cycle back in the 19th century or whenever, or the early 20th century. And people argued it was a 10-year cycle because a 10-year cycle was the average lifetime of capital goods. Okay, so you had this replenishment cycle of capital goods every 10 years, and that was really the factor that caused this frequency or this oscillation in world business. Well, to my mind, capital markets now are all about debt refinancing, and what you're looking at here is a refinancing cycle, and that refinancing cycle must be dictated by the average maturity of debt, which happens to be around 65 months. So that would be my explanation. And then why does it cycle? I think it's because you've got these two spheres of liquidity. You've got a financial sphere and a real economy sphere, and money is moving between the two. And as you start to think about how this works, as liquidity is drained out of the financial sector, it goes into the real economy. The real economy starts to get momentum. More liquidity is then pulled out of the financial sector until you start to see constraints like rising interest rates or lack of liquidity, which then causes the real economy to slow down. Money is then released back again into the financial sector, and so on. Ad infinitum, you get these cyclical movements. So the average length is about the maturity of debt, and the fact that you've got a cycle is to do with the fact that you've got two pools of money.
Well, there you have it. And as we're looking forward towards this great debasement, the big print that is still yet to come, of course, we have gold and we have Bitcoin. Through your analysis, what have you found to be the better monetary hedge in cases of big inflation?
Well, that's a key question. I think the answer is that if you look at the last 15 years, crypto has been by far and away the best monetary inflation hedge because it's the most sensitive asset to liquidity. There's no question about that. In terms of consistency, and if you want to look at the long term, and you can't dismiss the fact that gold has been a monetary hedge for over 2,000 years or so. Gold has got it in terms of consistency, and Bitcoin or crypto have got it in terms of impact or multiplier effects. So I think that you've got to choose, in my view, a basket of the two, and I would basically hold both, and maybe you could weight them in terms of their volatility. That may be a sensible thing to do. But to come back to one of the points that I made earlier on, I think that China is mainly driving gold simply because number one, Chinese retail investors can only buy gold as a monetary inflation hedge. They don't have the luxury of crypto anymore. and the Chinese state is buying gold anyway to back the renminbi or yuan currency. So there's a lot of demand for gold out there, officially and privately. And then I think if you go back to the Bitcoin crypto story, I think that's generally about Western debt and Western debt monetization. And I think that's happening very clearly in front of our eyes now. It's happening in a subtle way that people don't realize because it's coming through bill financing. And that bill financing is sort of, if you like, it's QE operated by the banks, not by the Fed. So it's more difficult to see, but it's happening nonetheless. And that's what's going to drive the prices up in the long term, because the Great Debasement is not today or tomorrow; it's out there in the future, and it's going to happen because there's no other way for it. All this spending that the governments are taking is mandatory spending. The only way to stop that is basically for governments to take away Social Security and welfare payments, to reduce defence. That's not going to happen.
No, they tried a little bit with Doge, and that was an experiment that quickly failed. But when it comes to Bitcoin and us Bitcoiners, we like to denominate a lot of our wealth in Bitcoin sort of as a protest, right? To get out of the system and to have an alternative to fiat. And so I'm sure many Bitcoiners listening to this today would have over 50% of their net worth in Bitcoin. But I've heard you say that you can get the majority of the benefits of the Bitcoin monetary hedge with just a 5% allocation in your portfolio. Explain that number, 5%, and how it protects you.
Well, the reason that's a slightly loaded question. What I was saying in that case is that I'd said the average investor who wants a monetary inflation hedge, if they were thinking about putting 30% of their assets into monetary inflation hedges, given the relative volatility and the, if you like, the impact effect, the bigger multiplier, if you like, on crypto, they'd only need to have as little as 5% in there to have a monetary hedge that was equivalent to gold. So if you like, let me put it more specifically. So if you've got, if you look at the multiplier on liquidity for gold, it's around about 1.5-ish times. So in other words, for every 10% increase in global liquidity, monetary inflation, you get a 15% increase in the gold price. That's a fairly, that's a fairly decent estimate of that multiplier. If you look at crypto, it varies up to maybe 8 times or thereabouts. So it's hugely bigger. But what I was saying is that is about 6 times the ratio to gold. And so if you're having 30% of your portfolio in monetary inflation hedges, you only really need to have 5% in Bitcoin and 25% in gold to have exactly the same effect. So that was what I was saying.
Oh, that makes perfect sense. But Michael,
have more if you need it.
if you love it. If you love it, yes, absolutely. Yes. And so in parting, I wanted to ask you, you've had Bitcoin on your radar for years now. Have you grown more convicted in Bitcoin the longer that you've studied it?
The answer to the question, I mean, there are 2 answers to this question, right? The first is there going to be a clever way in terms of the technology where the Bitcoin protocols could be cracked, that it could be made illegal? There could be some constraint on using it. I'm not an expert on that. I've got no idea. Okay, I assume in good faith that it's going to continue, right? Okay, into the very long term. So to put that question aside, the second question is it demonstrating a consistent relationship with macro variables that we can monitor and assess and plausibly, attribute effects to? And the answer is yes. And every month or day or week or year that goes past gives us more confidence and more data, extends the sample. And that looks to be, Bitcoin is behaving exactly as Bitcoin should perform, as I tried to say in this sort of chart. And you look at the correlations through that period. Over the last 4 to 5 years, the R squared of that data series is over 30%, but it's about 0.35 R squared, which for any financial, if anyone's done financial modeling, for any financial variable, that is a huge, hugely high correlation or R squared. And that's pretty impressive. And the two series are completely unconnected. I mean, one is the flow of liquidity and one is the price of Bitcoin. And that's all I'd say. So the answer is to the second, 100% yes. And then the answer to the first one, I don't know, but I'm acting in good faith on that.
Well, there you have it. We as a Bitcoin community highly value your insights into global liquidity and how it ties into Bitcoin. And it's good to hear that Bitcoin does have a correlation that is able to be studied and watched over time to global liquidity, because that's why we're here. We know they're going to have to print, and we think Bitcoin can provide us with that protection for our purchasing power. Well, Michael, thank you so much for your time. Where should people go to find out more?
Well, I think there are two sources. I mean, one is that we provide data largely to institutional investors for doing modeling, and we write more detailed narratives about the data, and that is available from Global Liquidity Indexes, which is glindexes.com website. And then for more narrative research and some data, which is more for sort of general investors, there is a Substack called Capital Wars, which we've been writing for a few years, that basically publishes about 3 times a week, both data and narrative on sort of key topics in the financial space.
There you have it. Well, thank you so much for your time. We're going to have you come back on.
Well, that's very kind. Thanks, Rob. Enjoyed it enormously. Thank you.
Cheers. Thank you so much for making it all the way to the end of this interview. If you enjoyed it, be sure to give it a like, comment down below, tell us what you thought, subscribe to the channel, and turn on notifications so you don't miss any of the interviews that we put out on a weekly basis. If you want to dive deeper, be sure to check out the interview that we just did with Steven Franson. He is a writer, social commentator, musician, somebody with a lot of really interesting views on the way that society is formed, human relationships, and where we are going as a country. It was a really deep conversation, and I think you would enjoy it. I'll see you over there.